All right, let's get you up to speed now on the Fed. A few Fed bank presidents are speaking today, and Jen Schonberger has the details for us. Jen, what are we hearing?
Hey there, Dave. Good afternoon. San Francisco Fed President Mary Daly says she's not convinced on signs inflation may be cooling yet and says we've got a ways to go. Speaking virtually at the American Enterprise Institute this afternoon, Daly says the key to bringing down inflation is rebalancing the labor market in order to bring wage growth down. Take a listen.
The labor market remains quite out of balance. We have too many jobs and too few workers. So that means that wage inflation is going to be above its long run sustainable average, and we're going to have that passing through to prices. And that's what we're working on right now. That's why my projection has gone up.
Daly, like other Fed officials, says she thinks the unemployment rate will need to rise to about 4.5% or slightly higher to restore balance in the job market. She says wage growth is still running around 4.5% to 5% and needs to come back down to 3.5% to 4%. Daly says that means higher rates held longer. When asked whether holding rates at high levels for some time, as Fed Chair Powell has said, means 11 months, as has been the case historically, Daly called that reasonable, but said that the data will determine that. Now, elsewhere, New York Fed President John Williams told Bloomberg Friday it remains possible the Fed raises interest rates more than it currently expects next year, adding that he's not expecting the economy to fall into recession. Now, officials have penciled in estimates for rates to peak around 5.1% next year. Of course, they have repeatedly revised higher their estimates for rates every single SEP we've gotten this year, and Powell did not rule that happening again at the March meeting next year.